All right, let's dive into one of the most powerful, but also one of the most misunderstood tools in the entire trading world, the RSI, the Relative Strength Index. We're going to really get into it.
So here's the big question, right? Why does this one indicator, which is on pretty much every chart, cause so much pain? You know the feeling. You see the RSI creep into overbought, you go short, and then you just watch in horror as the price keeps ripping higher. It's frustrating.
And look, this isn't just a hunch. The data backs it up. A whopping 58% of retail traders who use that traditional RSI strategy actually lose money. That's a huge number, and it's all because of a fundamental misunderstanding of what this line on the chart is actually telling us. So first things first, let's just completely demolish the core myth that leads to all those losses. Seriously, it's time to unlearn the first thing you are probably ever taught about the RSI. This is it. This is the rule that gets hammered into everyone's head from day one. If it's above 70, it's overbought, so you sell. If it's below 30, it's oversold, so you buy. It sounds so simple, so clean, and honestly, it's dangerously wrong. To really get this right, we have to pop the hood and see what this engine is actually doing. We need to understand what the RSI is truly measuring. And here is the absolute key. The RSI is not measuring if a price is too high or too low. Not at all. It's measuring the speed and the strength of the price moves. Think of it less like an altitude meter telling you how high you are and more like a speedometer telling you how fast you're climbing. Big difference. I mean, this right here just shatters that old myth into a million pieces. Can you imagine selling Bitcoin the first day its RSI went over 70? You would have missed out on a nearly 400% rally. That overbought signal wasn't a warning to sell. It was a screaming sign of incredible, sustained buying power. So here's the bottom line. In a really strong trend, seeing the RSI pegged in overbought territory is a feature, not a bug. It's the market telling you that momentum is off the charts. Trying to short that is like stepping in front of a freight train. Okay, so now that we've cleared away all that rubble, let's start building a new framework, a professional-grade way to use the RSI. This is where we build a real strategy. First up, and this is huge, context is everything. The RSI is not a one-size-fits-all kind of tool. If you're in a ripping uptrend, you should actually be looking at the 40 or 50 level as a potential support zone to buy a dip. But if the market is just chopping sideways in a range, well, that's when the classic 70 and 30 levels can actually work for selling the top and buying the bottom of that range. Okay, next up, divergence. This is one of the most powerful things the RSI can show you, but it's also where a ton of traders get tripped up. Regular divergence, where price makes a new high but RSI doesn't, warns you that the trend might be losing steam, a potential reversal, but hidden divergence is the opposite. It's a sign the trend is probably going to continue. You absolutely cannot mix these two up. Now, let's talk about a pattern that so many traders just completely miss. It's called the failure swing, and it's one of the most reliable signals the creator of the RSI ever identified. The best part? It all happens right inside the indicator window. So here's the playbook for a bullish setup. First, the RSI dips below 30 into that oversold area. Then it bounces back up. Then the price dips again, but this time, and this is the key, the RSI fails to go back below 30. It holds that level. That failure is a huge tell that the sellers are exhausted, and it often comes right before a big move up. Now, of course, even a great pattern like that shouldn't be used all by itself. You never want to use any indicator in a vacuum. The real magic happens when you pair the RSI with other tools that confirm you're on the right side of the main trend. So here's a simple but super effective filter. Just toss a couple of moving averages on your chart to tell you what the main trend is. And if the price is in a clear uptrend above those averages, you do one thing. You ignore every single sell signal the RSI gives you. Doesn't matter how overbought it looks, you only use it to look for those pullback opportunities to buy, like when it dips back to that 40-50 support zone. And does this simple filter actually work? You bet it does. Just by making sure your RSI signals are aligned with the dominant trend, you can boost your win rate by an average of 15 to 20%. I mean, that's a massive, massive edge to have. So let's wrap all of this up by completely reframing how we look at this indicator. It's time for a new mental model. This is the single most important takeaway. Please stop thinking of the RSI as a simple red light, green light trigger. Instead, I want you to start thinking of it as a fuel gauge for market momentum. Once you see it that way, everything changes. Think of it like this, okay? When the RSI is hanging out around 50, that's a full tank of gas. The market is ready to make a big move. When it gets way up above 70 or way down below 30, it means the car has been flooring it for a while and the tank is getting low. But a car doesn't just instantly stop when the fuel gauge hits empty, right? It sputters and might need to pull over and refuel. In the market, that refueling is just a pause, a little consolidation, often right before the trend continues on its journey. So, I'll leave you with this question to ask yourself the next time you pull up a chart. By making that shift from seeing an indicator as just a simple trigger to seeing it as a tool that helps you read the market's story, well, that's when you stop gambling and start trading with real insight. And that, my friends, makes all the difference in the world.